Welcome to Roth Conversion Secrets. In this video, we'll explain how converting a traditional IRA to a Roth IRA can move future gains into a tax-free environment while also covering the immediate tax consequences. We'll emphasize two critical details: your tax basis and the calendar. We'll also reveal how to avoid the dreaded pro-rata trap that can derail backdoor Roth strategies. And we'll highlight the December 31st conversion deadline. Along the way, we'll use diagrams, examples, and quick quizzes to help you master the rules. Let's begin. Here's our roadmap. First, we will discuss why conversions can be powerful. Next, we'll break down tax basis and the role of IRS Form 8606. Then, we'll dissect the Pro-Rata Rule and why it's a common pitfall. After that, we'll distinguish between the December 31st conversion deadline and the April contribution deadline. We'll then show how to keep conversions clean and walk through a practical step-by-step plan. Finally, we'll cement what you learned with a case study and short quizzes. Before we get started, please note this content is educational only and not tax, legal, or financial advice. Your situation is unique, and tax rules can change. Consult a qualified professional before taking action. Let's start with the motivation. A Roth IRA allows qualified withdrawals to be tax-free, meaning future gains can compound without additional taxation. Additionally, original Roth IRA owners do not have required minimum distributions, which provides planning flexibility. Conversions can be especially attractive in lower income years or when you anticipate higher tax rates later. There are also estate planning advantages, as beneficiaries may receive tax-free distributions subject to rules. Now that we see the upside, we should understand the tax mechanics that determine how much you'll owe this year. This flowchart maps the steps for a clean backdoor Roth. First, you contribute non-deductible dollars to a traditional IRA. Next, you ensure that across all traditional, SEP, and simple IRAs, your pre-tax balance is zero. If you do have pre-tax dollars, you roll them into an employer 401k plan that accepts roll-ins. Then you convert the traditional IRA to a Roth IRA. Immediately after, you record your non-deductible basis using IRS Form 8606 to avoid double taxation. Finally, you verify that as of December 31st, your IRAs show zero pre-tax balance to avoid the pro-rata trap. Remember, the conversion itself must be completed by December 31st to count for that tax year. Now let's unpack basis. Your basis is the total of your non-deductible, after-tax contributions in traditional IRAs. When you convert to a Roth IRA, only the pre-tax portion is taxable. Basis is not taxed. To protect your basis, you must file IRS Form 8606 for each relevant year. If you do not file Form 8606, the IRS can presume the entire conversion is taxable, which could result in unnecessary taxes. Therefore, you should keep detailed, permanent records, including contribution dates, amounts, and copies of all prior Form 8606 filings. Let's quantify it. Scenario A. You contribute $6,000 after-tax dollars and have no other pre-tax IRA dollars. Converting $6,000 is fully non-taxable. Scenario B. Suppose your year-end total IRA balance is $50,000, with after-tax basis of $10,000. That means 80% is pre-tax. If you convert $6,000, 80% or $4,800 is taxable. Scenario C. With $30,000 total and $15,000 basis, half is pre-tax. Converting $6,000 makes $3,000 taxable. The Pro-Rata Rule looks at all your traditional, SEP, and simple IRAs combined as of December 31st. This diagram illustrates how the pro-rata mix determines the taxable portion. In the first example, 80% of the IRA balance is pre-tax and 20% is basis. Therefore, any conversion inherits this ratio: 80% taxable, 20% non-taxable. In the second example, the mix is 50-50, so half of any conversion would be taxable. The key is that the ratio is calculated across all traditional, SEP, and simple IRAs combined as of December 31st. Here is the core of the issue. The IRS applies the Pro-Rata Rule across all your traditional, SEP, and simple IRAs. The formula for the taxable portion of a conversion is the conversion amount multiplied by the fraction of pre-tax balance over total IRA balance. If you hold any pre-tax dollars in any of these accounts, your conversion becomes partially taxable. To run a clean backdoor Roth, You must have zero pre-tax IRA dollars across all such accounts on December 31st. Quiz time. The question is, which accounts are included in the IRS pro-rata calculation for a backdoor Roth? Your options are 1. Only the specific traditional IRA you convert. 2. All traditional, SEP and simple IRAs combined. 3. Roth IRAs and 401(k) plans. 2. 4. Only SEP IRAs if they have employer contributions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is all traditional, SEP, and simple IRAs combined. Roth IRAs and employer plans such as 401(k) plans are not included in the pro-rata calculation. This aggregation is why pre-tax dollars anywhere in those IRAs can taint your conversion. To avoid the pro-rata trap, first review every traditional, SEP, and simple IRA you hold. If you have pre-tax dollars, see if your active employer 401(k) accepts roll-ins and move those pre-tax amounts there. Then, make or confirm your non-deductible traditional IRA contribution. After you confirm your pre-tax IRA balances are zero, convert the traditional IRA to Roth. Complete IRS Form 8606 to document your basis and the conversion. Finally, verify that your December 31st statements reflect zero pre-tax IRA balances across all IRAs. This timeline contrasts two deadlines. First, the conversion deadline is December 31st. The transaction must be fully processed by this date to count for the current tax year. Meanwhile, IRA contributions for the prior year can often be made up until the April tax filing deadline of the following year. Note the year-end warning window from mid-December to December 31st, when brokerage processing often slows, making it risky to wait. Converting earlier is prudent. Let's emphasize the calendar. Your Roth conversion must be completed and posted by December 31st to count for the current tax year. In contrast, IRA contributions for the prior year are allowed until the April tax filing deadline. Because brokerage backlogs often increase in late December, it's wise to initiate conversions earlier and confirm specific cutoffs and processing times with your custodian. Second quiz. By when must your Roth conversion be completed to count for the current tax year? Your options are 1. By the April tax filing deadline of the next year. 2. By December 31st of the current year. 3. Any time as long as it is before you file taxes. 4. By the January 15th estimated tax deadline. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is by December 31st of the current year. Conversions are calendar year events. If you miss that date, your tax liability shifts to the following year. Comparing timing decisions. Converting now can lock in today's tax rate, start tax-free compounding earlier, and reduce future required minimum distributions. The downside is increased taxable income this year, which might affect Medicare premium surcharges or other phase-outs. Waiting may allow conversion in a lower income year and provide more planning time, but this risks higher future tax rates, forgoes tax-free compounding, and introduces deadline risk if you delay. Let's reinforce two actionable details. First, the key formula is taxable portion equals conversion times pre-tax balance divided by total IRA balance. Second, always file IRS Form 8606 to document your non-deductible basis and any conversions. Third, maintain a permanent folder with statements, contribution confirmations, and Form 8606 copies by year so you can prove your basis if needed. Let's recap the essentials. Roth conversions can unlock tax-free growth, but you may owe tax this year on pre-tax amounts. The Pro-Rata Rule aggregates all traditional, SEP, and simple IRAs when computing the taxable share. To run a clean backdoor Roth, aim for zero pre-tax IRA balance on December 31st. Remember, conversions must complete by December 31st, while contributions for the prior year can be made up to the April tax deadline. Finally, file Form 8606 to preserve your basis and prevent double taxation. Here is a concise action plan. First, audit every traditional, SEP, and simple IRA. Second, if eligible, roll pre-tax IRA funds into an active employer 401(k). Third, execute the conversion early to avoid last-minute processing delays. Fourth, File IRS Form 8606 and archive your records. Finally, recheck balances on December 31st to confirm that your pre-tax IRA balances are zero. Thanks for watching Roth Conversion Secrets. If you found this helpful, please like the video, share it with someone planning a backdoor Roth, and subscribe for more smart money content. Drop your questions, experiences, and any pro-rata war stories in the comments. I'd love to hear how you navigated your deadlines in Form 8606.